We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mark O'Byrne, silver and gold expert, entrepreneur, consultant, mentor, speaker, and founder of Goldcore and Tara Coins. Mark, how are you today?
Very good, Tom. Good to be back on with you.
Yeah, I can't believe it's been almost 2 years here. It's always such a pleasure to get caught up and, see things from across the pond and see things from your perspective. But I wanted to start today by talking about, let's say, the type of insurance that gold and silver offer. You've been speaking and highlighting how internet shutdowns all over the world have affected people and have affected how people are able to use and access everyday services that are all internet based. So why is this a growing risk right now?
Yeah, it's long been a risk. It's been sort of an underappreciated risk for a long time. And I remember writing about it 10 years ago or more than 10 years ago, because I was actually very surprised to see the amount of internet shutdowns that have happened around the world over the years, including in India, which is a massive subcontinent with over 1 billion people, and it's a democracy. And they've engaged in dozens and dozens and dozens of internet shutdowns, frequently when the government has felt at threat from civil society or from protests or any form of dissent, So it's a way to control narratives and conversations and ultimately the psychology and the consciousness, and then the politics and economics, actually, yeah. So I was amazed how frequently it happened. And I suppose I became aware of, we're becoming much more dependent on tech and on all things digital, and that's wonderful. I mean, I love technology. I'm not a Luddite, and technology is great, and there's huge benefits from it, and it's great. It does raise the standard of living of people, and we should embrace it. But we have to be very clear that there are also, like most things, there's pros and there's cons, and there's an upside and can be a downside as well, particularly in terms of who controls the technology and what their intent is in terms of using the technology. So it's interesting. And it also played into, actually, I did a lot of research over the years on obviously looking at gold and silver, why they are a store of value, and use the word insurance. They're a form of monetary insurance. They are a form of, they can be a means of exchange in certain circumstances. It's interesting right now, some of the coins that I'm minting are actually being used as a means of exchange in farmers markets and local markets, So, but generally they're not used as a means of exchange, and they're used as a store of value, and they're a monetary asset, And that's what they've been throughout history. And that's what I strongly believe they will continue to be, Obviously, we have the rise of cryptos, we have the rise of Bitcoin, and that they're being positioned as the alternative digital gold, if you will, Bitcoin in particular. When I was looking at this and sort of evaluating it, I really was quite concerned that the risk on the digital side has not been appreciated, So that applies to Bitcoin, it applies to cryptos, it applies to all different applications, websites, if you have governments with executive powers, sweeping executive powers, and we've seen quite authoritarian government in recent years, obviously. We don't need to go into the gory details, but it poses risk to people, because particularly when it comes to your money, and obviously feeds into the central bank digital currency question and that potential risk as well, So I think internet shutdowns, all forms of digital risk, also ENP. I remember reading on the front page of the Financial Times, probably around the time of the financial crisis, I think it was around 2009, 2010. And on the front page of the Financial Times, they're talking about electromagnetic warfare and electromagnetic pulse EMP technology, whereby a small nuclear warhead could go off up in the sky above New York or London, and it could take down the entire electrical grid. And we're so dependent on chips and on computers for everything, in terms of our entire way of life, the financial markets, the exchanges, your basic infrastructure in terms of traffic lights, hospitals. If electricity goes down, you have quite a serious issue with your entire economy, And so I was also looking at the move to the cashless society and how being dependent on using, this tap thing with your credit card, or now indeed with your iPhone, that there is a risk of that both to the individual but also to the economy, So gold and silver are just they're, when owned in their true way, they're not bought as a speculation. They're bought not to make money. You can make money, and there's nothing wrong with that per se. I'm all about people making some money, but it shouldn't be the primary motivation. It is a hedge, and it is a safe haven form of money, and it will protect it, particularly against these sort of growing technological risks that we see in society.
Mm-hmm. Mark, obviously, if we get an internet shutdown, we can have the Bitcoiners say, well, you can transact off chain and, without the use of the internet. I think that only applies to so many people that know how to do that and that have the ability to do that. But does this risk also apply elsewhere, let's say in gold ETFs or digital gold platforms as well?
It does, yeah, in a huge way. I mean, the whole financial system is in effect hugely dependent on technology, and even the futures market obviously is we used to talk about paper gold and paper silver, but it's not really paper anymore. Obviously, it's electronic,
Mm-hmm.
So your whole entire futures market is dependent on it. But then just your transactions in terms of Wall Street financial products, exchange traded funds. I mean, the risk in the gold and silver exchange traded funds. And it's interesting because when you look at the growth of the Bitcoin exchange traded funds, there's the same risks with those ETFs as well, in terms of when you read the prospectus of the various ETFs, there's a huge amount of exposure to the custodians and the sub-custodians and the owners of these assets. In effect, that they have an asset that in effect tracks the price of gold and silver, tracks the price of Bitcoin, but they don't have any ownership or any safety or any security in terms of actually owning the underlying assets, which is the whole point of owning, particularly gold and silver, obviously, but also Bitcoin to an extent, particularly in terms of the original modus operandi or the original intent of Bitcoin was actually as a means of exchange. It was clearly said by Satoshi Nakamoto in the paper, whether you believe he wrote the paper or not, but the paper clearly says that it was not to be used as an investment, So all these financial assets, they have a lot of risk. People can be disintermediated, and the assets can be very easily, if providers, custodians, sub-custodians go bankrupt or insolvent, then, people will almost certainly lose all their money, The chap, David Webb, I believe his name, has written the book, The Great Taking. And in that book, he details how, ownership of stocks and bonds are very vulnerable as well, and they're owned frequently via online brokers, So it's a funny one. People are hugely dependent on this, both the financial system and also now this digitized financial system. And it creates a lot of risk, not just in terms of ownership of assets, but also in terms of liquidity, So I just think more thought should be given to it. And I think it underlines the case as to why physical gold and silver should remain a key part of a diversified portfolio, and to be aware of the risks in these basic online structures and these new digital assets,
Mark, I think the argument could be made that cash would be a good form of currency in a time like that as well. So do you think that, obviously understanding that you're taking the risk of inflation by holding cash, what place do you think that cash still has to serve as a hedge against that type of risk that we're talking about?
I think there's a place for it. Yeah, absolutely. And I have encouraged people over the years to have some cash and have it outside the system, Obviously, you have to be very careful with these things, how you own that and how you keep it safely, And ideally, it's probably good if you have it, in a safety deposit box or someplace that is very, very safe and is accessible in these worst case scenarios, So, before taking delivery of cash, you have to obviously feel very, very secure in your own home. So it wouldn't be recommended for everybody. But yeah, both in a portfolio, there is a place for cash. But I do think the bail-in legislation, it poses very real risk to online deposits, So it's important to distinguish between online deposits and money that's in the bank in digits, in dollars, euros, and pounds, from actual cash notes, whether it be, 50, 100, 500 euro notes or $100 bills. There's a hugely important distinction there. As you said, inflation is running at, who knows what the real inflation rate is. But I think most people, if they really thought about it, I think we've come down a bit, obviously, but I still think we're probably running at, 5-10%, And that's not that the price of things in general is going up 5-10%. It's that the purchasing power, people are losing, the value of the currency is going down roughly 5%, 10% per annum versus real assets, particularly food and energy and the cost of essentials. So cash is a good short-term liquidity thing. It's good to have some. But I do think, and you have to think a little bit short-term, obviously. But I think always better in terms of long-term thinking about investments and savings. You're better off thinking in the medium and long term and thinking about what your goal is as well in terms of, because different people have different goals. If you have a 30 or 40-year-old person with no kids, they have a very different mindset, different goals than someone who's 70 or 80 and they have children. And so a little bit of cash is good, but I do think for longer term, again, you're better off sticking with gold and silver and get clear what your goals are in terms of how you're using this form of saving. Is it to fund your children's education? Is it to buy a business in a few years' time? Is it to buy some property or some land in a few years' time when there's a bit more value? Obviously, we have an everything bubble now, and the stock markets are very, very risky indeed. And you've covered this on your show a number of times, obviously. The property markets in many big cities that look very vulnerable. So it's a good time just to be liquid, and gold and silver are two of the most liquid assets in the world, physical gold and silver. So I think it's interesting, even the initial word cash, I think it goes back to the initial word cash. I think it's including Chinese, and I think it actually meant gold and silver coin. So, but in modern parlance, cash is obviously paper notes. So, yeah, I mean, it's a long way of saying a little bit of cash is good, and cash is king. Cash can be king absolutely in the short term, and it can come in very handy in various situations. I would always encourage people to have some cash. The question is just how much and how do you do that in a safe way.
We're talking about these ideas of internet shutdowns or internet controls, and we've seen this new TikTok ban legislation coming out of the US. Do you think that could kind of creep into this territory of ability of government, or let's say government overreach into shutting down other programs other than just TikTok?
I do, yeah. And I've seen very respected analysts who've written about it saying that this is much more than about TikTok. It's about control of communications and control of freedom of speech. And so the legislation is being passed basically gives them powers to, I actually have the wording here, websites, desktop applications, mobile applications, augmented and immersive technology applications operate directly or indirectly, including through a parent company, subsidiary, or affiliate. So, I mean, it's very broad ranging and very, very, encompasses, a lot of online things, so it can give, in the worst case scenario, if you have quite a dictatorial president, or in the EU now, we have a president that's becoming more and more centralized the power. So if you have a centralized power in an executive, they can issue sweeping orders to potentially ban certain technologies, whether it be TikTok or WhatsApp or Telegram, or even potentially websites, and who knows, that could be used against, Bitcoin if it was seen as Bitcoin was seen as a threat to the dollar and to the financial system and to Wall Street, the banking system, or indeed more probably, because I don't think Bitcoin is a real threat to the financial system. Otherwise, I don't think Wall Street would be promoting them via their ETFs and using them as speculative instruments. So a bigger risk is, where we're going that as gold and silver. Yeah, it could be used basically to shut down websites potentially. I mean, it sounds very drastic and very draconian, and hopefully it's unlikely, and maybe it is unlikely. Possibly it's more to be used against, from a geopolitical point of view, against Russia or China or whoever the US in this instance is at war with. So, but it's very dangerous. Obviously, the trend is very dangerous, and war by its very nature is very dangerous. It's very destructive, and young men get killed in their droves. And we're seeing that obviously in Ukraine and Russia. And women and children are dying in the Middle East, and it's very costly in terms of human lives, and that's shocking. But it's very costly in terms of no one's talking about the impact of this on our economies and the monetary impact of this, the fiscal impact of this. It's the amount of money that's being created, to fund these wars. It's very, very expensive, and you can see it reflected in the share price of some of the arms companies, and associated companies, so money is moving into that sector in a big way, and it's not healthy for the wider economy though, and it's not healthy for the middle classes and the working class. It only benefits a tiny, tiny elite, and again, it's that risk of censorship. The whole point of Bitcoin is that it's decentralized and private, and you know, you can have it off grid, if you will, and all the rest. But there's my understanding from talking to very experienced technologists, particularly in IT security, is that there are backdoors into nearly all devices now, whether it be iPhones, iPads, notepads, PCs. And that creates risk to people in terms of, you know, most of our assets are accessed via, you know, usernames and passwords, and you log into the account and all the rest. So that creates a lot of risk. And I don't think a lot of people are fully appreciating. And it does speak to the need to having a gold and silver and assets properly as well, obviously, you know, having proper assets that are offline. I think tangible assets again, rather than digital assets. And this needs to be a conversation around that, you know, because I think that was obviously the great attraction of gold. There's a number of attractions of gold in terms of, you know, its safe haven qualities, it's portable, it's tangible, durable, liquid, all these things. But the durable, tangible aspect is very, very important, you know, and Bitcoin doesn't have that because it's obviously just digits on a screen, and you're dependent on, you know, you mentioned about people there who have it off chain, all the rest, but there's only a tiny, tiny amount of people who have that technological expertise and can do that, you know. So by its nature, the market becomes much, much more limited, you know, and therefore much less liquid. So I do think, yeah, in terms of Bitcoin, I'm sort of straying again, but I do think the Bitcoin thing, it does concern me now at $73,000, $74,000 per Bitcoin. You know, I'm actually I'm sort of pro Bitcoin in terms of the technology, you know, from a libertarian perspective. I understood it. I actually, early days, I was, you know, writing about it in a much more balanced way than many people in the gold industry, because I did see the potential in it, you know. But then I did see over the years how people, quite senior people in the financial media, who were very anti-gold and were continually bashing gold and silver and calling people gold bugs and just not really engaging in facts and the data about gold and silver, they suddenly became great proponents of Bitcoin in 2010, 11, 12. And I found it very curious. And they were sort of touting the benefits of Bitcoin as, you know, the same as gold, as digital gold. And yet they had been anti-gold, you know. So I just think that people just need to be wary. And, you know, I'm all for people, by all means, especially younger people, own a small of a Bitcoin. But this thing of everybody putting all their money and going maximalist in any one asset is absolutely crazy and dangerous, you know. And I do worry that a lot of younger people will get burnt, you know. I think it's very important that younger people should own gold and silver as well. That should be the bedrock, the foundation of their portfolios, you know. Not that they have portfolios per se, but of their savings, you know. They work hard when they put some money aside. A lot of them are putting it all into crypto now, you know, because they can't afford to buy a family home. They can't afford to buy a small little apartments because the property market's gone so crazy. So by all means, own a small amount of Bitcoin or Ripple or whatever cryptocurrency you favor, you know, and some of them will do very well indeed, but the vast majority will go to zero. And there's a possibility that Bitcoin could even go to zero, you know, and there's going to be huge volatility. So I do think they should, first of all, get the foundation, which is physical gold and silver. And then once you have that, then you look to Bitcoin and to the other cryptocurrencies. And the other thing is take a lesson from what's happened from the silver market in recent years. There's a lot of, you know, and I was guilty of it to a degree as well. You know, we all thought the silver price was going to go much, much higher in the silver squeeze. And, you know, we thought silver at, you know, $100 was quite likely, and it didn't happen. And a lot of people some people, contrary to the advice, but some people did put all their money into silver and into silver coins. And now, you know, they were hugely overweight one asset class. And now some of them are having to sell silver and the premiums are depressed. And so it is such a cliche, that diversification thing, but it's so important. And sometimes the financial professionals, they almost tell the young people that they don't have to think about diversification. But I think everybody should think about diversification. You know, I think it applies to everybody from a small saver investor to the larger investors and savers and high net worth, you know. So yeah, eggs and baskets, just to diversify but don't be putting everything into Bitcoin or everything into crypto, you know, because there are real risks there that, you know, in terms of internet shutdowns and even internet shutdowns. I don't exaggerate the risk of that as well, because potentially they're only for short periods. They have been for short periods of time, you know. An EMP could take down an electrical grid for a longer period of time, and there could be less liquidity. But obviously the risk is the cyber terror, the cyber war, and potentially it's a bigger risk, you know. And we've been warned about that every few days now by the World Economic Forum, and And we're seeing little bits of this in different parts of the economy, and different, websites and pieces of the infrastructure are being attacked and hacked, So that poses a risk to digital assets again, whether that be Bitcoin or your online brokerage account, So yeah, diversify. It's so important.
Yeah, I think that's a really important point to be made, that we need to think of all of these assets, not just gold and silver, as different buckets of liquidity in which to have. And it's important to not just completely bet on one horse. But, we're talking about all these, let's say, electronic risks or internet-based risks. How do you see the risks of bank failures going forward as well? We just saw the end of the BTFP program in the States last week. So do you think that we're going to see more bank failures coming in the near future here as well?
I do, unfortunately, yeah. And so, yeah, that fed into the last point when we were talking about the cash, the electronic deposits. So yeah, bail-ins. Okay, I'll come to bail-ins in a second. So yeah, already there's concerns about some of the mid-tier banks in the US. And then there's also ongoing concerns about UBS and Deutsche Bank. And Deutsche Bank is obviously one of the biggest banks in the world, one of the biggest banks in Europe. And if it was to go down, it would be akin to Lehman Brothers in terms of the systemic risk, So it's weird how people don't talk about it anymore, but that risk hasn't gone away, And then that Silicon Bank, there's a lot of big banks. They're not like household names, Wall Street banks, but there's some very big banks in the States that are quite vulnerable, So I do think it's a real risk. Yeah, I was looking at bail-ins and the risk of bail-ins for many, many years, and did lots of research on it, because I couldn't believe that it was barely being reported in the mainstream media, that this legislation was being brought in from central bank level down into the ministers of finance. And basically, they were saying that depositors in the banks would be taking haircuts akin to bondholders, and that you have your deposit guarantee of $100,000 or whatever it is. Is it still $250,000 in the US? I think it is, isn't it?
Mm-hmm.
Or did you guys take it down? Do you know?
I believe it's still 250. Yeah.
Is it? Yeah, I think it is 250 in the States, and we're 100,000 euros and 80,000 pounds sterling. So everything above that is basically vulnerable. And even that, the UK had a 250,000 pounds. There was interest in 250,000 pounds deposit guarantee, and they reduced that down to 100,000 pounds, and then they reduced it down to 80,000 pounds. And that wasn't even a financial crisis. That was quietly done in the House of Commons on a Thursday night, and barely reported in the media. So they wanted to bring it in line with the rest of the EU, because they didn't want the UK citizens taking the money out of the UK banks and putting them into German banks or Irish banks or French banks, where they didn't want the money coming in. They didn't want the UK to be attractive, whereby the UK had a higher deposit guarantee, and therefore capital from the EU could have flown into the UK because they had a higher deposit guarantee, So that's why they took it from £250,000 to £100,000, and then they took it to £80,000, which was equivalent to our €100,000. So they wanted broadly similar across both the EU and the UK, and the UK was part of the EU then, and obviously subsequently they left in Brexit. So Annie, the bail-ins, they are. I do think they're a real risk. At the same time, they're not a fait accompli, and some people speak about them as if they're 100% certain they're going to happen, And I'm not sure about that. I think they have it in legislation and they have the ability to do it. But I think, a lot of us really looked at it and really, wrote about it and did research about why this is a very real risk to the economy, because you start taking the savings off people, their life savings, and the middle class in particular, but also the deposits of the small, medium enterprise businesses, who are the backbone of most of our economies. You start taking their cash flows and the deposits from them. I mean, that would result in a depression the likes of which we've possibly never seen before. It could be hugely deflationary, which is actually the last thing they need is deflation. Obviously, they're trying to create inflation. So it's a funny one. I think, I'm not sure if they have all the stakeholders on board with it, including the banks themselves, including, various business interests are potentially against it as well. So it's not a fait accompli, but there is a very real risk there. And obviously there's the risk of the CBDCs is hovering in the background as well, that if you did get a big banking crisis again, which I do think it's only a matter of time, I do think and potentially we could see some of it. There's rumblings in the US banking system already. So, but having said that, I thought that we were going to have these crises a few years ago and they didn't come to pass. So these things can take much longer to manifest than we think they will. And plus, the psychology is very important, and momentum is a very important thing. And as long as the psychology of the mainstream investor is that these are not real risks, then, potentially the can be continued to be kicked down the road for longer and longer, because there's irrational exuberance in stock markets, prices remain elevated. So, and just one last thing on that is in terms of the policy response. So how will they respond to banks getting into difficulty? And there is the risk then that they potentially shut down the banking system for a period of time and do some form of reorganization. And you have bank holidays over, a long weekend, and banks are shut down for a period of time or potentially longer. And obviously you saw this in 1933. And then there's the potential dissident of potentially bringing in the CBDCs and forcibly converting some of the deposits into CBDCs. But even on that risk, again, it's important to say it's not a fait accompli. There can be scaremongering about these things that people are saying this is automatically going to happen and it's going to happen soon. There's a possibility it can happen, but the CBDCs, they haven't got the stakeholders on board. And, we're like on like forum, we're all about talking about the stakeholders, but I don't know if the biggest banks in the world are actually on board with the CBDCs because they, in effect, would be disintermediated. A lot of them have been moving away to a brokerage model and away from being traditional sort of banks in terms of providing deposits and lending, the traditional banking model, but some of them still do make revenues from deposits. And I think they also realize that this would be, create a massive systemic crisis, and a monetary crisis. So I think there's sort of tools that they have in the toolbox, but we shouldn't assume that any of these things will happen. And they are very powerful. I mean, many of us got it wrong in 2010, 11, 12. We thought we were on the verge of a collapse. And we knew that they patched up the system in 2012. And Mario Draghi himself said that with the quantitative easing programs that they kicked the can down the road. So we knew they kicked the can down the road, but we thought the road would probably go to a few months or a few years. We didn't think it would last. Here we are 12 years later. So they are very, very powerful. They have lots of tools in their toolbox. And the bottom line is, in some ways, not in some ways, a lot of people sometimes they want this sort of crash and a crisis and they want to get it over with. And I do understand that logic to an extent, but in some ways, slowly is better. And I don't think it's anyone that body's interest to have a massive global systemic financial crash, By kicking the can down the road, it gives people more time to prepare and protect themselves from the various risks that are out there.
Well, hopefully people are taking this time to prepare and understand these risks. But if history is any guide, I don't think that step is being taken by most people.
It definitely isn't, unfortunately. And a lot of them are being sucked into Bitcoin and crypto, and it is being positioned as the safe haven store of value, And yeah, it amazes me actually to see some of the media and how they're reporting it,
Mark, I want to get your take on how you're seeing the gold and silver, especially the bullion industry, evolve currently. It seems like there's a significant new trend of many new private mints globally, and they're minting a whole new array of bullion, whether that be coins, metals, rounds, etc. Has this created a huge increase in the stock of gold and silver coins in recent months? And what has that done to premiums?
Yeah, there is. It's very interesting. There is that trend. It's akin to what's happened with the brewery industry, whereby there were a few giant monopoly breweries and giant corporates in that space. And then also we saw huge growth in sort of microbreweries in the last, 10, 15 years. And there's a similar thing happening in the gold and silver industry. And it's interesting. I think it is an evolution because I think people are realizing, well, why are we paying huge premiums for, say, silver eagles, as an example, or gold eagles to the US Mint, simply because it's legal tender. And people were willing to pay that premium because it is legal tender. And that's what's called a coin. But then there's a large segment of the marketplace who are saying, well, the coin doesn't actually give us a whole lot of benefits per se, in terms of paying a much higher premium. Why wouldn't I buy a silver round or a gold round that is half the premium or a much lower premium? And on the sell side, the premium isn't much lower either in terms of the spread, So it's an interesting thing. And that's why I think, as you said, that these private mints have popped up and they're sort of catering to that niche of the bullion buyer who is buying more about the intrinsic value. And so there's also getting the niche of the collectors. And obviously there's a huge, particularly in America, there's a massive numismatic industry and a lot of people who are into their collectibles, and they buy some of these gold and silver coins not primarily as a store of value, but also as a sort of a collector's items. And obviously we have NGC and PCGS and these people who are grading the coins. So it's all about the quality of the coin, And And I think they are sort of quasi stores of value as well, but you have to be careful with them because there is a big difference and big spread between the buy and the sell side on them. But there's a place for them, let's just put it that way, in the portfolio. And that's what we're doing as well. We're sort of tapping into that niche. So in terms of supply, yeah, there is definitely a lot more supply in the marketplace. And that's coming from both this burgeoning, growing minting industry. But I think it's also coming, I think it's actually more so coming from the existing mints. I mean, there's a huge increase in supply from most of the sovereign mints. And that has created a glut in recent years, and the inventories have gone very high, very, very high indeed. And it's been quite depressive for the industry as a whole. So I think that is beginning to change somewhat, obviously, with gold at record highs. But I've been surprised with gold at record highs that there's still inventories there, and that there's definitely an uptake in demand for both gold and silver, more for gold because at record highs, but not so much for silver. And silver, obviously, silver is 1/86th of the price of gold, so it's still great value at these levels. But the silver stackers haven't come back as much, and there are quite large inventories there still. And the question then is, will they come back in? And yeah, I know from talking to you and talking to different people in the industry, there is a concern that when silver goes to $30 per ounce, potentially some people will use that as an opportunity to sell because they've been underwater for a period of time, and they thought silver was going to go to $50, $100. They went all in, and it hasn't. And obviously we have a cost of living crisis as well, and people have financial pressures now. So there could be quite a bit of liquidations around the $30 mark, say, in silver. So, but at the same time, and that will, possibly impact the bullion market again and the bullion dealers, and it will impact premiums. So, but I do think, given the extremely positive fundamentals for silver in terms of the supply side, what we're seeing with the decline in production in Mexico and Peru, but also on the demand side in terms of international demand, and we have to remember that it's a global marketplace, a massive global marketplace with huge international demand. So even if the silver stackers and coin buyers in America sell at a $30 per ounce mark, or even if someone wait to the $50 per ounce mark and take profits, and I would encourage them to take profits. I think people need to be taking profits. And I think a lesson learned in recent years is, don't be waiting for that big number that the guru tells you is going to go to. And I've heard this so many times, and people over the years tell me that so-and-so said the price is going to go to 100 or 200, gold's going to go to 10,000. And it's like, we just don't know. Nobody has a crystal ball. There's so many variables, so anybody who tells you it makes any sort of predictions, obviously, you completely discount it. But I think most analysts who I respect believe they're going to go much, much higher as the currencies devalue, but be taking profits, and the Bitcoin people should be learning from this as well, when something goes up as much as it's gone up, take profits, and the same principle we use in terms of cost averaging to accumulate a position. You should use that maximum and use that. It's wisdom. It's very wise that you can cost average out of a position and say, right, when it gets to $40, I will take some profits on some. And if you really think it's going to go to 100, then maybe you take profits at 85, 90. Don't be waiting for that magic number, and then have a core position and say, well, this is my core position. That is insurance. I'm not going to sell this. But, if you've gone slightly overweight any assets, then you need to be taking profits and rebalancing, So, yeah, and silver goes to $30 per ounce. But yeah, I think the industry, it's a good question because I don't actually know the numbers. I don't know if the industry knows the numbers in terms of the World Gold Council and the LBMA. Do we have on the silver industry, do we have good, strong numbers on the amount of rounds, as an example, or medals? And in the industry, in America in particular, a round is sort of a non-legal tender coin. It's just a circular disc, but the industry tends to call a coin a legal tender is a coin. To me, a coin is a coin is a coin. But yeah, if it's non-legal tender in the US in particular, they're called rounds. But yeah, I don't think there is strong data on the amount of rounds that have been minted. I'm pretty confident that I need to double check that, and I will check it again because it's very, very interesting, and it's important that these numbers are recorded. But I think the psychology is going to change, and I do think we are going to see a wave of demand come in at some stage, and I do think we're going to see obviously much higher prices as the currencies devalue. And it's because of that global demand, particularly from China and India. And we're seeing that now in the silver market, which is obviously we've seen huge demand for gold in particular in China and India in recent years. But the silver demand hasn't been so big in Asia, but that is beginning to change now as well. So I think that will very much support silver when it gets up to the $30 level and when it gets to higher levels again,
What do you make of the inventory drawdowns in the big ETFs like SLV or GLD? Is this a positive or a negative for the industry?
I think it's a positive for the bullion industry and negative for the ETF industry. And I think that gold is the data suggests that gold is flowing to Asia again and China. I mean, we always talk about China and India because they're so huge, and there's fairly good data on that. But a lot of it is going in, it might be going into via Singapore, via Hong Kong. There's Thailand, there's a lot of precious metals going in there, into Malaysia, into Indonesia. I mean, there's a lot of very big countries down there with huge growing middle classes, and we don't really talk about them as much. So, because all the focus is primarily on China, especially in recent days, because we've seen with the Chinese New Year, the Year of the Dragon, that there was, and obviously they have quite serious financial issues in China itself. There's worries about the property market and the financial system in China. So there is a bit of a mini gold rush going on in China, whereby we're seeing the footage of people queuing up around the block and all the rest. So, yeah, so it's positive. It's definitely positive. Sorry, I'm almost certain it's positive. I can't see any other conclusions. I think that where is that metal going is the question, and almost certainly it looks like it's going to Asia, and it's going to very strong hands in Asia who will not be selling that. These people are buying for the medium and long term. It's not a speculation for them. Yeah, so it is positive for them.
Do you think that some of these bullion banks are being caught in a short position here as well, and that they are going to end up having to pay a lot more to clear those positions?
I think so, yeah. I follow Bob Coleman and obviously David Morgan and a few people who are quite good on this on Twitter and in different research they do. And that seems to be the case. Yeah, I'm not as following it as much as closely as I used to day, but that short squeeze risk is still a very real risk, and position. It's worth keeping an eye on the managed money positions and who's long and who's short. And Ted Butler, the older Ted Butler, not the younger Ted Butler, who's come on the scene recently, who's doing some good work as well. Obviously he keeps an eye and does a good job informing us of what's going on there. Yeah, it's funny. It's a bit like the boy who cried wolf. That there's many people in the industry have cried wolf so many times, and especially when that last silver short squeeze was happening, people thought this was it. So it looks like this could be it, but we just don't know. And who knows? There's peaks and troughs and there's waves and there's, the potentially if the silver price sells off again, there could be some supply comes in the marketplace and potentially this silver squeeze that we're expecting doesn't happen for another year, 2 or 3 years,
Mm-hmm.
But I don't know. There's a lot of mood music and there's a lot of moving parts that suggest that we could be on the verge of, and even technically, obviously, we have to look at these markets from a fundamental perspective and a technical perspective, and fundamentally, the supply demand, physical gold, silver, for both of them, but particularly silver, it's very, very positive, potentially as positive as it's ever been. And there's even parallels with, 99, 2000 in terms of, a supply demand perspective, So, and then from a technical perspective, we've gone through the $2,000 per ounce very strongly now on gold. And it's psychologically, that was a big number that was proving hard to get through. And we've gone through it quite convincingly, and we've had monthly higher closes. And so it looks very, very good technically. Also silver, I think $25 per ounce silver is very important, obviously. And then the $30, $29, $30 per ounce level that you mentioned as well. But I think a lot of people probably possibly been selling at these levels now. The more I think about a glut of selling coming at 29, 30, I think there will be some of that, but I think a lot of that selling is possibly already taken place, But who knows? We don't have crystal balls, and diversify and have the tools of liquidity, as you said, and own as much in the tangible as well, And there's a place obviously for mining shares in that mix, but I would be, just a little bit cautious. They're not, as we've seen from a performance point of view, they're not the leverage plays of gold and silver that we believe they are. They are very depressed in price, so they should do well, But there's a different set of risk with mining companies as well. You just need to be aware of that,
Mm-hmm. Excellent, Mark. Well, I think that's a good place to kind of wrap up for today. Is there anything else that you'd like to share with our listeners before we do?
No, I think we've covered the bases. Yeah, just diversify, have different eggs and baskets, but do try focus more on the tangible. I think the next 5, 10, 20 years, I think the rationale for having tangible assets, I think that will be understood again, and it's very, very important. And yeah, so own these tangible assets and own them in the safest way. And I think will weather whatever potential little storms are on the horizon, you know.
Absolutely. Excellent, Mark. For those that want to read more of Mark's work, it's all available at Mark T. O'Byrne on Twitter. That's probably the best place to check all that out, right?
And LinkedIn as well. Yeah, I don't do as much research as I did before, but I do a little bit. And yeah, so you can follow me on LinkedIn, on Twitter, and then the website. We do occasional updates on the website as well. It's Tara, T-A-R-A, coins.com.
Excellent. Mark, thanks so much for your time today.
Thank you, Tom. Thanks for having me on. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.